The government confirmed today that the U.S. labor market is in real trouble when it reported that incomes have slowed way down into the danger zone. We already know that hours are being cut, American workers don't want to quit where they're at, hiring is non-existent, and even a trickle of layoffs have begun to permeate. No surprise then that the latest statistics on personal income show the weakest growth yet, right on into the leading edge of recession territory. And I mean in nominal terms too. We don't even need to adjust for prices to see it coming. It's not GDP you want to watch, it's income. That's why consumer spending looks all right, like in the last GDP report I talked about yesterday, but consumer pessimism is exceptionally high. Those two don't seem to make sense. But the deterioration in jobs and employment is just now starting to get big enough that it's hitting the major statistics like personal income, which is the most important one of them all. It takes time for the weakness to work its way through a large and complex economy. The fall off in labor doesn't impact everyone the same way and at the same time. Most people aren't affected by it at all, at least not at first. But once there are enough hours being trimmed or the utter lack of hiring goes on too long, it does begin to pile up and create problems for enough people, and that's when we start to see it in economy-wide incomes and other statistics too. And that's what the government reported today, continuing the trend that has been building to the downside since around March and April. And it is having an impact on spending and economic activity. We see this most clearly in the auto industry. Stellantis just today reported truly grim results, though they weren't exactly a surprise. But now Ford too joins Stellantis in having way too much inventory. Sales are weaker than expected, and it's not because of high interest rates. The real reason here is incomes and employment. They can't sell enough cars because consumers are worried. Even if they're not seeing it today in their own experience, they're concerned. They can tell the labor market has shifted. Income opportunities are disappearing. And so they're not buying cars. And pretty soon it's going to have an even bigger chilling impact all across the rest of the economy too. What CNBC reported for Ford, let's start there. They said heading into Monday's results, several Wall Street analysts were concerned Ford would need to lower its forecast due to softening demand, rising vehicle inventory levels, and worries about Ford's ability to achieve and announce $2 billion in cost cuts this year. And the company ended up guiding at the lower end of their range anyway, as they reported a slowdown, not just a slowdown, but an outright decline in the number of cars that they actually sold, which has left the company struggling with too much inventory. Management said that Ford, they have 91-day supply of gross inventory, including vehicles in the company's possession, and there's about 68-day supply on dealers' lots, at least at the end of the third quarter, which, as CNBC says, has concerned investors, which of course it should. Overall, the company for the third quarter reported a 2% decline in the actual number of wholesale units sold. That's in their Ford Blue section, which is the vast majority of the company anyway. And for the first 9 months of the year, they've sold 3% fewer units than they did in the first 9 months of last year, which is why inventory has been piling up. Because contrary to expectations, the economy isn't solid and steady, at least not for automakers, in 2024. They all expected that the recovery would continue 2022 on into 2023, and the good times would last, with 2024 being maybe a transition year, but a transition into a soft landing, and then 2025 recovery thereafter. So they kept making cars despite the fact that interest rates were rising, and we're told that interest rates are the biggest reason that car sales have gone down. But no, car makers themselves were not concerned about interest rates. And you can see this in Stellantis especially. Stellantis had its stock price surged up until March. The business seemed to start changing earlier this year. Number one, coincident to the huge increase in auto insurance costs that was in the CPI, as well as gasoline prices. The economy had weakened sufficiently that it started to have a negative impact on the auto business. It wasn't interest rates, it was the economy, macroeconomic factors. And now that consumers have seen the slowdown in the labor market start to show up in incomes, which means they perceive it throughout their own experience, it's big enough that it's showing up in incomes that consumers can definitely tell what's going on. They're not really in the mood to buy a whole lot of cars, which has left inventories to rise and therefore companies like Ford and most of all Stellantis to have to cut back on production. What Stellantis reported, their revenues in the third quarter were down a whopping 27%. Worldwide shipments fell 20% to just 1.1 million units. And it was even worse in North America. North American revenues fell 42%. This is in the third quarter year over year. Shipments were down 36% as basically the company had to turn off production because it had built up and piled up way too much inventory. They thought 2024 was going to be strong and robust. The labor market in the United States and the rest of the world too, Europe in particular, had other ideas. As of the middle of the year, the reason why they cut back on production were dealers were revolting, number one. But number two, Stellantis had 430,000 cars and units on dealer lots. And so they announced that they were going to try to get that number down to 330,000 by the end of the year. And what they just reported is that they're maybe halfway there heading into November. So what if the situation actually gets worse? They've already halted production. I mean, shipments have just basically collapsed from the company. They're hoping that this is just a one-time, let's take our medicine, get the pain out of the way in the short run, and then everything picks up on the other side. But what if it doesn't? What if this isn't about high interest rates? What if the Fed isn't going to cure it with rate cuts? I mean, after all, interest rates in the marketplace where it actually matters, they have been going lower since last October. Interest rates move off of the Treasury market, not the Fed. So interest rates have been moving down and car sales have been falling. And it's not any coincidence that car sales have been slowing down and then falling right around the same time that we see it in all across the economy, especially the labor market, and as we'll see incomes in the U.S. as well. As incomes in the labor market turned around March and April, the first real macroeconomic impact on the spending side has come in the auto business. And that's a key one, as I talked about in the recent video. That's a key cyclical indicator. If we lose the auto business, that means even more trouble ahead because it goes way beyond just selling cars. We continue to get more and more signs that the broader labor market is not just unhealthy, it's getting worse as this year progresses. And we'll talk about incomes in just a minute, but before we get to that, another one coming from Challenger, Gray, and Christmas on both job cuts that are announced as well as hiring plans. And they both confirm that job cuts continue to be high, at least relative to where they've been recently, at the same time that the biggest problem the economy has, the one that's really holding back incomes, nobody is hiring. So what Challenger Gray reported for the month of October, they said October's total, this is for job cuts, marks the 7th time this year job cut announcements are higher than the corresponding month 1 year prior. So far this year, companies have announced plans to cut 664,000 thereabout in jobs, up 3.7% from the 641,000 or so cuts announced in the first 10 months of 2023. And this is the new high, the newest highest year to date since the 2.1 million that were announced in 2020, obviously, and we exclude 2020. 2024 is the highest year-to-date total since 2009, when just under 1.2 million cuts were recorded. And according to the press release, job openings have fallen and hiring is pretty flat at the moment. Companies appear to be in a holding pattern as we await election results and the potential regulatory and market environment that follows. So they're blaming it on election uncertainty because why not? That's the flavor of the day. Before it was high interest rates, now it's election uncertainty. There's always some excuse why the economy isn't as robust as everyone says it is, certainly from the perspective of the third quarter GDP report. But as I said yesterday in that video, GDP doesn't tell us anything about what the economy is doing moving forward. It just tells us what happened moving into this quarter, what just happened in the latest quarter. And what that means is that output may have grown by nearly 3%, but it doesn't tell us if it was enough output to keep employment growing or if it was the right kind of output, especially with so much dedicated to federal government spending on quote-unquote defense. Essentially, GDP is agnostic about the business cycle, and as I pointed out, we've seen GDP in the same exact range, both nominal and real terms, at every single cycle turn going back to the beginning of the post-war era. So GDP doesn't tell us what's going to happen, it just tells us what did happen. And these other suggestions from the labor market are strongly suggesting that what did happen was nowhere near enough or it wasn't the right kind. And when we look at Challenger Gray, they reported the fewest year-to-date hiring plans outside of 2020 since 2015 and 2016. We're going to keep coming back to those comparisons a lot. And remember, 2015 and 2016, a couple of the worst years during one of the worst decades for the labor market in modern history. So anything being compared to that, as we'll see, like incomes, that's already a huge red flag. We already know that the labor market has been heading in the wrong direction, including from the establishment survey from the month of September. Well, the headline payroll figure was seemingly robust, and there's all sorts of questions surrounding that. I mean, revisions that are coming, QCW, as well as how these payroll reports aren't really reliable around cyclical inflections. Apart from the headlines establishment survey, the government already reported a significant reduction in hours. Hours have been basically flat, coincident to everything I'm about to talk about here. So hours are not growing. We already know unemployment is stacking up, even though the unemployment rate dropped a little bit over the last couple of months. The momentum in the labor market is moving in the wrong direction when you filter out that 1 September payroll number. But also, we got jolts this week too, again for the month of September, where American workers do not want to quit their jobs. And the reason they don't want to quit is because what jolts also showed is no one is hiring. Not only are people not hiring, businesses aren't hiring, we also see a trickle in layoffs. Not quite as much as Challenger Gray and Christmas has found, but according to the government's estimates, there does appear to be a rising trend in layoffs. Whether or not this is the big one that kicks off the parts of the recession that we all recognize, that remains to be seen. But so far in the early stages, it is consistent with everything else that we're talking about here. The potential start toward a rising trend in layoffs. Fewer hours, nobody quitting, nobody hiring. Maybe some firings are starting to trickle up too. And with that background, of course, incomes are going to be slowing down. And as the labor market continues to deteriorate as much as it has, incomes don't just slow down. They slow down in the same way and by the same amount that is consistent with the danger zone, recession territory. And that's what the government reported today. Now, when you look at the statistics, at first they look okay. The year-over-year change in nominal personal income, which includes everything. This is the big one. This is the top line. Nominal terms, all forms of income. Personal income increased by 5.5% year over year. So that's September 2024 compared to September 23. And that sounds solid. But what you don't realize in the year-over-year comparison is that the slowdown is just starting to emerge over the last 4, 5, maybe even 6 months. So when you look at personal income on a 6-month basis, that change is just 1.9%, which is obviously a huge slowdown for a half a year period. So 5.5% year over year, 1.9% in the latest 6 months. Major shift in the latter 6 months compared to the first 6 months. And you look at the last 3 months, again, this is nominal personal income, rose just 0.8%. These are incredibly low numbers that, as we'll see in just a moment, are solidly in recession territory. And this is what has driven consumer pessimism. They can see the slowdown. They can see all of these factors in the labor market. And it is having such an impact that it's showing up in personal income. They know the labor market is not as strong as the headline payroll survey makes it out to be, at least in every one of these few months that turn out to be much more positive. We'll see about what happens tomorrow. But essentially, consumer pessimism is everything that's captured in personal income slowing down. It's telling us that the labor market situation has gotten to be so serious that aggregate nominal personal income is in recession territory. And we talk about just nominal DPI, or disposable personal income, which factors in taxes. Same thing there. Nominal DPI is up 5.3% year over year, but just 1.7% on a 6-month basis. And in the last 3 months, so basically the summertime time for recession, nominal DPI is up just 0.7% over the summer. That is well within recession territory. Now, to be clear, incomes by themselves are not recession signals. They're not exclusive, they're not exhaustive. They don't say, hey, if you see this, it means recession. But it's like retail sales. When we see the growth rate in nominal incomes fall below a certain threshold, it is consistent with labor markets and general economic conditions that are like recession. So there's other factors to take into account, but this is a big one telling us that all the stuff that we're seeing up to this point is indeed serious enough that is causing this amount of trouble. And that's what consumers are saying. They realize it too. When we look at incomes in real terms, real disposable personal income, for example, that one has been flat for really the last 6 months. It was a little bit less than 0.1% growth for 2 months in a row now, and just a little bit over 0.1% for the 2 months before that. So you see basically summertime really going back to June, almost no income growth when you adjust for prices, which is kind of a surprise, or which is kind of remarkable given the fact that price changes have slowed way down too. And just like before, real DPI 3.1% year over year, but just 0.9% over the last 6 months. Major slowdown even when you adjust for prices. And when you exclude transfer receipts, which is another big one too, another big factor, real personal income excluding transfer receipts, which is just basically private economy income adjusted for prices, only 2.9% year over year, and just less than 1% over the last 6 months, and just less than 0.4% over the last 4 months as well. Major slowdowns across all the major categories where it comes to income, whether in nominal terms, real terms, excluding transfer receipts, even with transfer payments. And just to emphasize this point, let's go back to nominal personal income, just to show you how serious this is. Nominal personal income, we'll use the 6-month rate of change, which means that we're not just focused on a couple months here or there. 6 months is a long enough period of time to rule out random fluctuations. And since we've seen a massive slowdown over the last 6 months, we can make some comparisons with other historical periods. I mean, you can even see the current slowdown. It's visible on a chart that goes back 65 years. You can see how personal income has shifted and slowed way down over the last 6 months. What I'm showing you here on the chart is any time when nominal personal income on a 6-month basis is growing at a less than 2% change. So it's obvious in the 2020s, you see the clusters where nominal growth is well below 2% in the 2020s for very obvious reasons. But you also see, for example, the middle of 2019, starting in June of 2019. That was the recession scare. The Fed scared into cutting interest rates, global recessions, inversion in the yield curve, all the signals that we got that the U.S. economy was heading into a pre-pandemic recession. Well, nominal income was right there with it. And we don't know how that one would have turned out, but that's another one strongly indicated there was serious weakness in the middle of 2019. We also see really weak income growth in the middle of 2015 into 2016, the mini recession in the middle of the 2010s. We also see the same thing in 2011 and 2012, that mini recession back then. Substantial weakness in the labor market leading to real big time slowdown in nominal incomes. And notice that these three are Eurodollar cycles, number 2, 3, and 4. So what we're basically saying is that nominal income that we see today in 2024 is equivalent to some of the worst parts of the 2010s, which happened to be one of the worst decades for the labor market in modern history. So obviously, if we're in that same territory, we're also going to be compared to late 2007 and the middle of 2008 when nominal incomes fell off. Also the same thing, middle of 2001, you don't see nominal personal income fall below 2% on a 6-month basis until the recession had already begun in 2001. And then they stayed weak in the jobless recovery afterwards. So no surprise you're getting this solid correlation, not just with general macro weakness, but periods that correspond to lack of hiring, labor market woes, lack of income. It all goes together. Same thing in early 1991 in the middle of the S&L recession, though you do see some gyrations and weakness in the early 1990s overall. So like I said, this is not a solid single recession signal, but what it does tell us and what it does confirm is that labor market woes have gotten to be such a degree that it's showing up in incomes in a way that's consistent with conditions that are like recession. So when you combine nominal personal income or nominal disposable personal income with other factors, what you see is everything that's just like a recession period. The labor market has indeed fallen off substantially, and substantially enough that it is impacting incomes, which is impacting consumer confidence and behavior, and it leads to more of the vicious cycle. But it's just starting to emerge, and that's an important point that needs to be emphasized repeatedly. That accounts for why consumer spending appears to be so robust, because the labor market slowdown is just now emerging in a serious way. It's just getting started. And that slowdown takes time to affect, first of all, incomes. It doesn't impact everyone in the same way at the same time. It takes time for hours, lack of hours being trimmed, lack of hiring, for wages, and maybe even some layoffs to get serious enough that they make so much of a difference that now we can see it in nominal incomes. And people begin to react more and more as all of this continues. And certainly one thing they're not going to do is buy a whole lot of automobiles. So that's the leading edge of the same thing we're seeing in the labor market, tied together with incomes that are showing just how serious this retreat has already become. And we've seen these coming over the past several months, but now they're getting to be more noticeable, and it's still right just around the edges. So while consumers are still spending, they're also worried that what they can see around the edges might be, and likely is going to be, coming for them too. Third quarter GDP looked to be rock solid, so soft landing, right? Well, GDP always looks rock solid just before the recession begins, and I went over all the details there in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. Until next time, take care.